All right, here we go. We're going to be talking about paying off debt today and 2 free strategies that you can use right now to work on paying off your debt and figuring out how much interest you owe to be able to pay less interest to the bank, less interest to your creditors, and more money in your pocket. So right off the bat, we're going to go into it. We need to define a term today, and that term is amortization. And all that is the action or process of paying off debt regularly. So the reason we need to know this is because we're going to be talking about an interest calculator today. This is also known as an amortization schedule, like I said, or an interest calculator. And this is really going to help you know where to focus your efforts and focus where you need to be paying off that debt that has the most interest, that is costing you the most money out of your pocket over the longest period of time. So most of the time, people don't just have one single debt, which is what you're going to find most of the time for these interest rate calculators. So I actually found a really good interest rate calculator that calculates multiple loans all at the same time. And this was on Loan Lab's website, and I will actually put that in the down below in the comments of this video so that you can actually look that up and you can actually figure out your interest that you owe on your loans yourself. Today, I came up with a little bit of an example using 3 different loans, and to kind of show you, depending on the term and the interest of your loans, you're going to have a lot of varied results. So for this first one, I took $40,000, and I'm assuming that's some type of student loan debt. So this may be something that you find yourself in, and I gave it an interest rate of 4%. And usually, you'll have an interest rate that is anywhere from 4 to anywhere upwards of 6-8%. So I picked 4 because I think that's somewhere in the realistic what maybe people have. And this is a term of 10 years, so they have 10 years to pay it off. So we can see what that did when I plugged those numbers into our amortization schedule. It created a payment of $404 per month. So this payment is pretty common for what you're going to see for different student loans for paying them back over time. Now, over the course of that 10-year loan, you are paying $8,597 of interest to that loan company. So that is a huge amount of interest. There's a few things that you can do to knock down this interest rate, which we're going to talk about here in just a few minutes. I also plugged in a $9,000 worth of credit card debt loan. So this is a huge amount of interest, 18% interest rate loan. If you have some type of debt like this right now, I encourage you to go out and try to find something that has a lower interest rate, somewhere you can consolidate that amount, but that is a large amount and that's going to be very hard to dig out of. And I gave them a goal of wanting to pay that debt off in 2 years. Now, obviously you would want to pay it off as quickly as possible because that is a large amount of interest. That's going to give you a payment of $449, and that's going to total interest over the course of that 2 years that you're going to be paying back is $1,783. So lots of interest there too. And then finally, I gave $30,000 for a car loan at 3% for paying it off in 5 years. So that gave you a payment of $539, and the total you're paying is $2,343 over the entire course of that loan. So quite a big bit of interest. So what can you do now that you know how much interest that you owe on your debts to pay this off even quicker? Now, the number one thing that you can do is obviously pay more money. So find a side hustle, find something out there where you can throw more money at the largest debt so that you can pay it off, especially when it has a high interest rate, quickly, as fast as possible. Now, let's just say that you're in a scenario where you don't have more money every single month. That is where I think this next thing is very, very important. And this is making 2 payments every single month. Now, you're not making the larger payment every single month. If you have a $404 payment, like we had in this example, every single month, all you're going to do is pay $202 every 2 weeks. And what this is going to do for you is, even though you're paying the same amount, since you are catching that interest rate earlier in the month, so you're only giving it 2 weeks to build up interest, and then you're paying down that interest and some of the principal, you actually are paying less money over the entire course of that loan. So This is another calculator that you can figure out for yourself what this will do for you. And this is from Bankrate, and I will put that link down below also. But all you need to know for Bankrate is you're going to plug in your amount of debt. So this one I used the $40,000 example, your interest and the term, and then how often that you want to pay it off. So you want to pay it off at least twice a month. So what you're going to select is you're going to select bi-weekly. Don't ask me why that's the terminology for it, but you select bi-weekly, and that is indicating that you want to pay it off 2 times every single month. So what that is going to do for you is if you do that and nothing else, the entire amount that you will pay on that loan is $7,685 in interest. So if you see here, in the first example, you're paying $8,597. So that's a difference of $912 that you're not going to have to pay of interest just by making 2 payments every single month. So go out, figure out how much interest you owe on your loans, figure out what loan you're going to tackle first and what you're going to put money towards. Then on every single one of your debts, start making 2 payments a month and start paying less interest to your bank, to your creditors, and have more money in your pocket. If you enjoyed this video, go ahead and like it down below, subscribe to our channel. Till next time.